Good evening, everyone. Hope you all are doing well. So today we are going to discuss lecture number 16 of IAS 19 Employee Benefit. What is what are the employee benefits? There are few kind of benefits. Let's say short-term benefit means within 12 months of your service, such as bonus. Long-term benefits provide after 12 months of service, or post-employment benefit means after retirement, such as pension, gratuity, and termination benefits, redundancy, golden handshake. Now, in our topic IAS 19 employee benefit, we will cover the post-employment benefits. In the post-employment benefits, we have two type of plan. The first one is defined contribution plan, and the second one is defined benefit plan. Let's read the content. First, we have scope. IAS 19 deals with accounting for all employee benefits, including short-term benefits, example wages, bonuses, annual leave, post-employment benefits such as pension, other long-term benefits, sabbatical leave, termination benefits means redundancy, and golden handshake. Now, post-employment benefit, pension plans. In the pension plan, we have two kind of or types of plan. The first one is defined contribution plan. This is a plan for the employee in which employer has no obligation or employer has no risk, means all the risk in this plan, defined contribution plan, associated with the employee. Let me give you an example. Let's say you are going for an interview in ABC and company, and in that company they don't have any kind of plan. So now you can ask whether you are going to offer any pension or any kind of retirement benefit. Now the employer told you that we do not have any plan, but if you want for your better future after retirement, then you can start funding from your own. Now the risk is from your own end. Let's see it. Risk of employee. Only employee will contribute in the fund, and it will be either gain or loss. That's why simple accounting for employer means if defined contribution plan is done by your employer on behalf of you, then of course the accounting will be simple for the employer. Contribution paid by employer. This is an outflow, so it will be reported in operating activity in cash flow. This point is related to cash flow. Why I mentioned this line here? Because if you read this content and once you move to the cash flow, so you will be aware of this thing. Your entry will be means employer entry will be P&L debit cash credit. Okay. Second condition is contributions are unpaid then accrued. It means payment of this year will be paid in next year. Of course, then you will have to book your payable. P&L debit, payable credit. Condition 3, contributions have paid in advance at the time of payment in advance. Prepayment debit cash credit means if any payment made in advance, the entry will be prepayment debit cash credit. Now, when the contribution expense is incurred, means you have used. Now, P&L debit, expense will be debit, and prepayments will be credit. Okay. Now, move to the defined benefit plan. On this topic, there are so many questions in your past paper exam. Please be attentive. Defined benefit plan. In this plan, the risk associated with the employer, as employer promised employee that I will provide you this and that benefit at the time of retirement. In this B plan, defined benefit plan, the employer has an obligation to pay you retirement benefit, means there is a constructive obligation. In most of the organization, there is a defined benefit plan. There is an example for you. Employer promised employee that you will get 50% of final salary as a pension Now, this is the risk of employer. Why? Because employer promise means employer has an obligation. Employer has to pay it at any cost. Now, IAS says as employer risk is high, so report it in financial statement means constructive obligation. If you have covered my lecture on IAS 37 provision contingent liabilities contingent asset, then you are much familiar with these terminologies. If employer covers insurance of its employees, it comes under employer risk. Means if employer has provide or given any insurance policy to any of its employee, then it will also be covered under the employer risk. The whole calculation for defined benefit plan is done through projected unit method. It means employee will earn pension every year. You do not need to worry about this method because we just do the accounting of defined benefit plan, the working, the calculation, all the things are done by the actuary. This is not our part of the work. The projected unit method, this is just for your understanding. The projected unit credit method attributes the benefit earned by the employee to each period of service considering future salary increases and actuarial assumptions like retirement age, mortality, discount rate, etc. Now, there are few things which you have to be understand in order to solve the defined benefit plan questions. First, we have current service cost. What is the current service cost? Current service cost means pension earned by employee in the current period but will be paid in the future. What does it mean? Let's say a company is just started and this is the first year of company, so this year employee will work hard and earn some pension. Now when this pension will be earned, pension earned by employee in the current period but will be paid in future. So what is the entry of current service cost? P&L debit, defined benefit obligation or plan credit. DBO is your liability. Now, past service cost. Amendments in the defined benefit plan. Sometimes the organization, the employer can amend their plan. And if the employer amend their plan, so it means it is a past service cost. And if the amend results in increase in your past service cost, then it is your interest, means expense. If your past service cost after amendment is decreasing, means it is a negative past service cost, which is income. Why income? Because your obligation will reduce, and whenever there is a reduction in the liability, it becomes income. Or you can say decrease in expense results in income. Now, amendments in the defined benefit plan, P&L debit, DBO credit. You will make this entry when the amendment results in increase in the past service cost. Negative decrease past service cost is the income, whereas positive increase past service cost is the expense. What if the amendment results in decrease? Then this entry will be reversed. DBO will be debit and P&L will be credit. Now there is an amendment example. Employees joined 3 years before. At that time, we committed to give them 50% of final salary as pension. But now after 3 years, we amend the plan. We said now we will give 55%. Now tell me after amendment, there is an increase or decrease. This is an increase, so it means it's an expense. Now you will make this entry. Pension of final salary, so this would increase our DBO, means it will increase the liability. Now we would take book complete obligation. Now whether it is vested or non-vested, means whether there is any condition or no condition. Now, which discount rate to be used for discounting? In your DBO calculation, you will get the figures, then you will have to discount it, means you will have to calculate it for the present value. So for that, of course, you will use the interest rate. Now the question is which discount rate to be used for discounting. High quality corporate bond interest rate. It will give you in question, so use that interest rate. What if high quality corporate bond interest rate not available? Then use interest rate of government bonds. This defined benefit accounting is must not only in case of legal obligation but also in case of constructive obligation. Same accounting is applied. Means either it is legal or constructive, same accounting will be applicable. We will cover the accounting once we done with these concepts. Now, actuarial assumptions. What are the actuarial assumptions? Judgment based calculation, as actuary calculate death based on an assumption. What are the assumptions? Demographic, such as mortality rate, qualification, and age. Financial, inflation, labor, and market competition. Actuarial gain, loss, or remeasurement component goes in OCI as it is an estimate. You guys are know this thing that estimates, whenever there is an estimate, it goes into OCI, other comprehensive income. Now, what is plan asset? Plan assets are assets held by a fund that are held by an entity, usually a trust, that is legally separate from the employer, are used only to pay or fund employee benefits, can't be returned to the employer except under specific condition. So it means plan asset is a separate entity. Let's say ABC employer has one employee, and for that employee, ABC maintain a separate plan assets in any trust or in any other institution. From that plan asset, ABC cannot obtain a single amount for their personal use. So this is called plan asset, funded plan asset. Now, examples of plan asset: investment in bonds, shares, or property held in a pension fund, cash and cash equivalents controlled by the fund, insurance policies if they meet specific criteria under IAS 19. If you go through these examples, it means the plan asset is a separate entity. It's not in the name or by the employer, means employer has no control over it. Why are plan assets important? They are deducted from defined benefit obligation to arrive at the net benefit liability or asset in the financial statement. If you are not getting this concept, just wait a minute. We will solve so many questions on this topic. Now, types of plan assets: funded or unfunded. Funded means separate. We have just covered this above, that whenever an entity, an employer maintain a plan asset, it should be funded. If it is unfunded, it means there is no plan asset, means no separate plan asset is maintained by the employer. Funded means ring fenced only for employees. Plan asset is separate from company. Company can't use plan asset for its benefit even if company is dissolved, liquidated. The creditors can't touch this plan asset. Sometimes it is in the form of qualifying insurance policy. Unfunded, no ring fence means not separate. Separate plan asset is maintained by company. Now, tip: funded plan asset safe for employee. Always go for the funded. If it is unfunded, it means there is no plan asset. Now, journal entries. Contribution paid by employer in plan asset, then the entry will be plan asset debit. Why? Because plan asset is increased cash debit. Plan asset is recorded at fair value. Plan asset debit, interest, income, credit. Define, sorry, benefit paid to employees, those who retired. In this case, you will have to debit your DBO and credit your plan asset. Now, funded versus unfunded plan assets as per IAS 19 employee benefit aspect. Funded plan, unfunded plan definition: a plan where the employer sets aside money in a separate fund, example, a trust, to meet future employee benefit obligation. A plan where no separate fund exists, the employer pays benefit directly when due. Plan assets. Yes, plan assets exist and are held in a trust or fund. No, no plan assets. Liability remains on employer's book. Example, pension fund with investment in shares, bonds, etc. and of service gratuity paid out of company cash. Accounting treatment. Assets and liabilities are shown net in statement of financial position. DBO plan asset means DBO minus plan asset. It could be net liability or net asset. Entire obligation shown as gross liability in SOFP. Risk to employees lower. In funded, the employee risk is lower as assets are set aside for benefit payments. Higher if company lacks cash, benefits may be delayed. Disclosure. Plan asset details, example fair value return must be disclosed. Only liability and payment information disclosed. In short, funded plan assets are beneficial for the employee, whereas unfunded are not beneficial. As in the funded, the risk is low. Why? Because it is maintained by the third party, or you can say an independent party, whereas unfunded is maintained or controlled by the employer. Unwinding of discount in defined benefit obligation entry. If there is an unwinding means interest, then the entry will be interest expense debit, DBO credit. Now, whenever there is a question on DBO, we will use this structure while solving the question. DBO and plan asset. Present value of DBO means brought forward. It will be present value. Always your opening will be present value. Present value of DBO opening. Add interest expense, add current service cost, add past service cost if positive. If it is negative, then you will have to deduct it. Why deduct it? Because it's your income. Less benefits paid. We have just read the entry. DBO debit, PNL credit. Benefits will be deducted from both DBO as well as plan asset. Just see. Now also we will get the closing value of DBO in the questions. Now the question is, what will be the balancing figure? The balancing figure will be actuarial gain loss, means remeasurement component. If you just go above, we just covered this here. Actuarial assumption, actuarial gain loss or remeasurement component goes in OCI. Okay. Now for the plan asset, fair value of plan asset, as we have covered, fair plan asset will always be recorded at fair value. So fair value of plan asset opening, add interest income, add contribution paid into plan, as the entry will be plan asset debit, cash credit, less benefit paid retired. Fair value of the plan asset closing. Again, in this case, the balancing figure will be remeasure component. It could be gain or loss. There is a note. Everything will be given in the question. You just need to calculate the present value by using the which interest rate, corporate or the government, whichever is given. Actuarial gain loss will be the report, will be the balancing figure, which will go in OCI. Items to be reported in profit and loss account from these two cases. Interest income in PNL, interest expense in PNL, current service cost and past service cost, either positive or negative, will be go in PNL. Gain loss on curtailment and settlement. We will cover the curtailment and settlement topic in the later section. Now there is a question for you. Question 1 line. The following information is provided in relation to a defined benefit plan operated by SINE. Transactions are assumed to occur at the reporting date of the relevant year. At 1st January 2004, the present value of the obligation was 140 million and the fair value of the plan asset amounted to 80 million. Mean these are the opening balances of DBO and plan asset. Now, we are solving for the 2004. Okay. Now, discount rate at the start of year is 4%. Current and past service cost is 30. Means past service cost, there is nothing mentioned about the amendment. So always take it as a positive, means expense. Benefit paid 20. Contributions into plan 25. Present value of obligation 200. Fair value of plan asset at 31st December closing is 120. Now, reconcile the movement for the year in the plan asset and obligation, determine the amount to be taken to profit or loss and other comprehensive income for the year together with the net plan obligation or asset at 31st December 2000 and export. The opening balances for DBO and plan assets are, you will have to solve this question like this structure if you are following my lectures. Otherwise, you can also follow your tutor's approach. Now, opening balance of DBO is 140 and the plan asset is 80. You can just get it from here. Okay. So your net is 60. Net liability is 60. How this is net liability? Because if you can see the DBO is 140, which is greater than the plan asset. So of course the net impact is net liability, which is 60. Interest expense 4%, 4% of opening balance, which is 5.6. There is no interest expense in plan assets, so it's a 5.6. Now, interest income, there is no interest income in DBO, but interest income in plan assets, so it's 3.2. 3.2, how 4% multiplied by 80 gives you 3.2. So you also have to write in the net column 3.2. I have maintained the net column by by reducing the DBO from the plan asset, means B minus A is net column. Net column is equal to B for plan asset and A for DBO. B minus A is your net column. Service cost, there is a service cost in DBO which is 30. So I have written down 30 here, B minus A. Benefits, so benefit is 20. We have to deduct 20 from both DBO as well as plan asset. Contribution from plan asset contribution will be added. Now closing balances 200 for the DBO, 120 for the plan asset. So the net is 80. How 80? 120 minus 200 is 80. Now, how to calculate the balancing figure remeasurement component? You will have to add or deduct all these things. Means in the 140 you will add 5.6, you will add service cost, then you will deduct 20. Now you got confused, then why you are deducting 20? That's why I have mentioned all the accounting entries above. If your accounting entries will be strong, then you will get this concept. Because the entry for the benefit was DBO debit, plan asset credit. That's why I have deducted this entry. And the entry for the service cost and the interest expense were interest expense debit, DBO credit. For the service cost, P&L debit, DBO credit. So once you calculate these figures, you will get an accumulate figure. Then from that figure, you will have to calculate the difference. The difference is 44.4, means this is your loss. How loss? Because once you add all these figures by adding the 140, by adding the 145.6, 30 minus 20, you will get the okay, you will get the figure of 155.6. Out of 155.6, the closing balance is 200. It means there is an additional liability, means liability is increased. So whenever there is an increase in liability, it means there is a loss. So the balancing figure will be loss, which you will have to write down in remeasurement component, which is 44.4. Now, for the plan asset, you will also add 80 plus 3.2 minus 20 plus 25 gives you the figure of 88.2. Out of this 88.2, you will have to calculate the difference. 88.2 minus 120 gives you the 31.8 is your remeasurement gain. How this is gain? Because you are in the plan asset column, and once your asset is increased, it means this is gain, this is an income. Okay, these are basic concepts. Now, so it means in the DBO you have a remeasurement loss which will go in PN in OCI, and in the plan asset column you will have a remeasurement gain which will also go in OCI. Now you will have to calculate the net impact. The net impact is loss as the amount of loss is greater than the amount of gain. So the net loss is 12.6 which will reported in OCI. Now made a journal entry. P&L debit 32.4. If you add 5.6 plus 30 minus 3.2, I have written down service cost plus interest expense minus interest income will give you this figure. OCI 12.6, balancing figure as there is a net loss because in DBO its liability is increasing, so it's an expense. DBO 20, net DBO as opening is 60 and the closing is 80, so net increase in liability is 20. Now cash 25 contribution. SOFP extract net pension liability. This 80 will be reported in your SOFP as a net pension liability. For the 2005, this is your assignment. You will have to solve the year 2005. The same method will be applicable on the 2005 year. Now, there is another question, question 2, Redo's company. RD company has a defined benefit pension scheme for its staff. Staff is eligible for an annual pension between the date of the retirement and the date of their death equal to annual pension. Final salary per year multiplied by years of service 50. You are given the following data relating to the year ended 31st December 2000 x3, means we are at the end of the year and the data will be given by the end of the year of 2003. Yield on high quality corporate bonds 10% per annum. Contributions paid by Redo's company to pension plan 12 million. Pensions paid to, this is benefit. Pensions paid to former employees 8 million. Current service cost was 3.75 million. Now, after consultation with employees, an amendment, highlight this word, was agreed to the terms of the plan reducing the benefit payable. The amendment takes effect from 31st December 2003 and the actuary has calculated that the resulting reduction in their pension obligation is 6. Now you can get the idea of past service cost. If there is an amendment and the amendment results in a reduction, means negative past service cost, it will become your income. Now, NPO, net present value of the pension obligation at opening, means DB opening is 45 and the closing is 44. Same fair value of the plan asset opening is 52 and the closing is 64.17. Let's solve this question. First, there are pointers. Amendment equal to past service cost, means plan is reducing, negative past service cost is your income. And the entry is reversal of the positive, which is DBO debit, plan asset, sorry, PNL is credit. Now, particulars, DBO column, plan asset column, net column, and the other column is classification. Okay, opening balance 45 for the DBO, 52 for the plan asset. Just got from here. Now, interest expense 10% on the opening gives you the 4.5. Interest income on the opening of 52 gives you the 5.2. Past service cost is 6. Why negative? This is your income. Just go through this entry. DBO is debit, so that's why we have had a negative sign.
Current service cost is 3.75, contribution 12, benefit 8 minus 8 from both. Closing is 44 for DBO and 64.17 for plan asset. Now, again, you have to calculate the balancing figure, which is remeasurement component. Remember, remeasurement component always go in OCI. It could be loss or it could be gain. Now add 45 plus 4.5 minus 6 plus 3.75 minus 8 gives you 39.25, and the closing is 44, means liability is increased, and whenever there is an increase in liability, it's your expense, your loss. So 39.25 minus 44 gives you 4.75. So 4.75 is your remeasurement loss, or which will go in OCI. You can also write it actuarial loss. Now for the plan asset, 52 plus 5.2 plus 12 minus 8 gives you 61.2, and your closing is 64.17. So it means there is an increase in the plan asset, so there is a gain of 2.97. Now the net is 1.78. How 1.78? 4.75 minus 2.97 gives you the loss of 1.78. This will reported in OCI. Now I have written a classification. Interest expense in P&L, interest income P&L, past service cost, this is income, so in P&L. Current service cost expense P&L, contribution cash under current asset. The entry is plan asset debit. In the previous question we have a DBO. Now in this question we have a plan asset. How we have a plan asset? If you just compare plan asset with DBO, in this case the value of the plan asset is greater than the value of the DBO, so it means you have a net asset. In this case you have a net asset. That's why I have selected this question, so that I can cover your both concepts. What if we get the net liability and what if we get the net asset? Now in this question you have a net asset of 7. Okay, so plan asset is 13.17. How 13.17 is calculated? Your opening is 7 and your closing is 20.2. Means the difference between these two is 13.17. And why is debit? Because your asset is increasing. Net plan asset as opening is 7 and the closing is 20.2. So net increase in plan asset is 13.17. OCI is 1.78. There is a loss, so 1.78 loss. PNL 2.95. If you add or less these classification by adding or deleting their amount, you will get the 2.9. And cash contribution is 12. Okay, in the previous questions, the closing value we have was, let me check, 80, and this 80 will be reported in SOFP under liability section as net pension liability. But what is the treatment in case of net plan asset? Here we have a 20.2 surplus of net plan asset. Now what is the treatment? Will it also be recorded as a non-current assets in SOFP? No, here you have to perform a test, and the test is asset ceiling test. Now read what is the criteria. Plan asset surplus means this one, this 20.2. Plan asset surplus will not directly recognize in SOFP as it relates to employee. So no employer, so an employer can't recognize it directly. If we go through, we just covered in the above slide that the plan asset is solely maintained by the employee, not for the employer. So plan asset surplus will not directly recognize in SOFP as it relates to employee, so no employer can't recognize it directly. Employer has to perform an asset ceiling test. Now the question is, what is asset ceiling test? Okay. So will this full surplus of 20.2 shown as non-current assets not automatically? Here's the full IAS 19 rule. IAS 19.64 para the asset ceiling rule. The amount of the net defined benefit asset 20.2 recognized in SOFP is limited to the present value of any economic benefits available to the entity, either in the form of refunds from the plan or reductions in future contribution. It means whenever there is a surplus, that surplus will only be recognized in the SOFP is limited to the present value of any economic benefits available to that employer. Now, so the employer must assess, can the rupees 20.1 million surplus be refunded to the company upon plan wind up? Can it be used to reduce future economic benefit? Sorry. If yes, full 20.17 is recognized as a non-current assets. If no, only the recoverable amount. Let's say in this case the recoverable amount is 15. So 15 is recognized and the balance is not shown. Now, in this case, I have make an additional twist. Let's say situation update. Fair value of the plan assets closing was 64.17. Defined benefit obligation closing was 44. So we have a surplus of 2017 million. But in your actual question, there is no such condition, but I have added this condition for your clarity. As per IAS 19.64 asset ceiling rule, only rupees 10 million of this surplus is recoverable. Means out of 20.17, only 10 million will be recoverable through refund of surplus or reduction in future contribution. It could be any one of them. Now this rupees 10 means the recoverable surplus will be recognized in SOFP as an asset under non-current asset. Okay. Now you are left with 10.17. Why total surplus was 20.17 and out of this total 10 is recoverable, which you have recorded in non-current assets. Now you are left with 10.17. The OCI loss due to asset ceiling is 10.7. 20.7 minus 10 gives you the asset ceiling loss. Remember, asset ceiling loss will also be reported in OCI. Will also be reported in OCI. Will also be reported in OCI. Now, the asset ceiling loss is 10.17. If you remember, we have an additional loss of 1.78 which due to remeasurement component. So what is the total OCI loss? The total OCI loss as a remeasurement component is 11.95, 1.78 from the above and 10.17 from the asset ceiling. I hope you are getting the things. Now we move to the curtailment. What is the curtailment? Curtailment means when an employer reduces the number of employees from the pension scheme. Reduction of number of employees from a scheme to remove employees from the pension plan. There are two types of curtailment. Curtailment A without settlement, B with settlement. What is without settlement means no payment of cash immediately. Whatever employees have earned in the last few years will be given to them at the age of retirement. Now, because of this curtailment, DBO balance will be revised. How will you revise your defined benefit obligation? Means your liability. DBO just before curtailment means from DBO at the time of original plan. DBO after curtailment means after reduction of employees. You will get the gain on curtailment. Why gain? because your liability will be reduced. That's why you will get a gain on curtailment. Gain on curtailment will be reported in P&L. And with settlement, employees sometimes demand to transfer pension earned to date in new employer account. Means it's settlement from our side. If our employees demanded to transfer their pension amount to their current employer account, so it means we have performed our liability. Our obligation means settlement is done from our side. Now, in which settlement, we have two cases. Case one, for funded, in funded plan asset is maintained. Let's say DBO was 95 and the plan asset which we have maintained for employees were 100. So out of 100, the DBO means the liability was 95. So there is an expense of 5 million, means loss of 5. Case number two, unfunded. In unfunded, no plan asset is maintained. Either we pay now, so we record cash. If we pay later, so we will record it as a contractual liability. DBO debit 95, cash contractual liability 100. So the difference is expense, which is 5. Now, question, this is for your assignment. This is the most easy questions if you solve the above two questions, which even I have solved for your understanding, but I must show you guys practice. Otherwise there is no point to watch or go through these lectures or notes. Now there is a note for you. If company books a pension scheme as defined benefit scheme, then company has to book DBO, which means liability and risk, in the book of employer. That's why companies deliberately want to book defined benefit plan as defined contribution plan. Unpaid contributions by employer are treated as accrued liability at the year end. Of course, employer has not yet paid, so it's an obligation for them. Remaining all accounting are same. P&L debit, OCI credit, accrued liability. Previously, we booked cash. Now the employer has not yet paid the contribution. That's why we record it as a liability. Okay, now we are left with two small concepts. The first one is cumulative bond. What are cumulative bonus? A cumulative bonus refers to a benefit that builds up, accumulates over time, and is carried forward until it is either paid out or utilized. Let's say entity A said to its employees to wait for the 5 years, then take the bonus. Total fair value at the end of fifth year of bonus is 500. Per year value is 100. How 100? Number of years is 5 and the fair value at the end of fifth year is 500. So 500 divided by 5 give you the per year value, which is 100. Now you have to calculate the present value at interest rate of 10%. After 5 years you will get this bonus, but what is the present value at this year, at year 1? You will calculate 500 divided by 1.01 power 4. Why 4? Because you are at the start of year 1. So from year 5 to year 1 you will have to calculate the present value for the previous 4 years. Present value at year 1 is 68.3. Now the employer will make this entry P&L debit, payable credit. Okay, there is a question. Current salary is 500 million, bonus 10% of salary per year, cumulative salary growth 20% per year, discount factor 10%, number of years 5. There is a table. First you have to write the number of years 1, 2, 3, 4, 5. We will just have to make the entry for the year 1. Okay, now current salary means at the year 1 the salary is 500. After the 1 year the salary growth is 20%. So the second year the salary is 600. How 600? 500 multiplied by 1.2 is 600, and in the third year is 720. How 720? 600 multiplied by 1.2. In fourth year 864, and in fifth year 1036.8. If you add all 5 year salary, then you will get the total cumulative salary of 3720.8, and the bonus is 10% of salary per year cumulative. So the bonus 10% is 378.08. Now, this figure of the bonus is at the end of 5th year. Again, you will have to calculate the per year bonus. 372 divided by 5 gives you the 74.416, and you have to calculate the present value. How? Just we have calculated above. 74.416 divided by 1.1 to power 4 gives you the figure of 50.8273. So your entry will be P&L debit 50.82, payable credit 50.82. Now, unpaid leaves. Unpaid leave means, let's say the employee are allowed to take 30 days leave in a year, and the employee take 20 leaves out of 30 leaves. So it means 10 leaves are unused. Now what to do in this case? Paid leaves, accumulating, non-accumulating. In case of accumulating, can be carry forward for future. If carry forward for future, then you will have to book original salary plus holiday pay accrual, means unused paid leaves. Okay, what if in case of non-accumulating? Can't be converted into cash or can be in cash. If cannot be converted into cash, no responsibility on employer. Employer just book original salary expense. But if it can be in cash, employer will book original salary as well as holiday pay accrual. Now, in case of accumulating, we have two cases. Can be carry forward indefinitely, means employee can use their unused leave anytime. Okay. In this case, can be paid, can be carry forward indefinitely. Book holiday pay accrual on full unused leaves. Case 2, can be carry forward only for 1 year. After that, it will be expired. Means only for the 1 year. Book holiday pay accrual according to expectation of vesting. Means according to the period of vesting. Now there are two questions. Question 1. Milk Limited has one employee. His name is Guy. Guy is of 30 days leave per year. Guy is paid 90,000 salary per year. That year is 365 days. And Guy is expected to work 5 days a week. Guy took 20 days leave in 2001. Guy is leaving non-accumulating, means this case, and assume that it is cannot be converted into cash, so just book the salary expense debit, cash credit. Question number 2. Mark Limited has one employee. His name is Jack. Jack is of 30 days leave per year. Jack is paid 365,000 per year. The year is of 365 days, and Jack is expected to work 5 days a week. Jack took 20 days leave in 2001. Jack leave is accumulating. Jack may convert leave that he doesn't wish to take into cash. The financial year end is 31st December 2001. Now required journal the transaction and calculate any leave pay provision. Highlight this word. Jack leave is accumulating, means we are in this case. Okay. Now, also it is accumulating, and Jack may convert leave that he doesn't wish to take into cash, means Jack has an option. Now, first calculate the working days. Jack expected to work 5 days a week, and in a year there are 52 weeks, so 5 multiplied by 52, 260 days. Unused leaves. Jack took 20-day leaves out of 30, so unused leaves are 10. Per day salary, 365 is the whole year salary, and you will have to divide with the number of working days. So per day salary of the working days 1403.8. Now unused leaves, holiday pay. Unused leaves were 10. and the per day salary is, so 10 multiplied by 1403 gives you 14038. And also you will have to book the salary expense debit cash credit, because in accumulating employer will have to book original salary as well as holiday pay accrual. That's it for IAS 19. I have covered all the topics, all the content which have been highlighted in your SBR exam. There is nothing to worry, there is nothing to left which you guys shouldn't cover if you follow my lecture, because I have a strong eye on your SBR syllabus. So no need to worry at all. Best wishes for your exam. Take care.